MC Laubscher here, the host of the Cashflow Ninja podcast and also the president and chief wealth and investment strategist of Producers Wealth, where we help our clients integrate cash flow banking, also known as infinite banking, with their business and investments. If you're interested in learning more about how we create strategies that integrate cash flow banking and investments to turbocharge them, you can access a video series at yourownbankingsystem.com. That's yourownbankingsystem.com.
Welcome to the Cashflow Ninja, the podcast sharing how to create income streams and manage, multiply, and protect your wealth in the new economy. Here is your host inside the dojo, MC Laubscher.
Hello, Cashflow Ninjas. MC Laubscher here, and welcome to another episode of the Cashflow Ninja. I have a great show for you today, and in today's show, we're going to look at how you can cash flow oil and gas investments. My guest in today's episode is Paul Mauceli. Paul is the president and founder of Reef Securities. As an entrepreneur, he has operated a number of companies in the service industry, and in 1994, joined his brother, Michael Mauceli, in the oil and gas industry. He has been instrumental in guiding the company since 1994. Paul has been advising clients on oil and gas investments, along with mentoring and leading a sales force of professional brokers for over 2 decades. He holds Series 22 and 63 securities licenses and a Series 39 principals license. If you're interested in joining our investors group, you can also go to cashflowninja.com/investors group and fill out an application form to see if you're a good fit for our group.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the United States. Our simple, proven system will help you create real wealth and passive monthly cash flow. Learn how to find the best deals by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing at noradarealestate.com. That's NORADA realestate.com.
Paul, welcome to the show.
Thanks for having me.
Can you share a little bit about your background and journey with my listeners?
Sure. I've been in the oil and gas business as I own a registered broker-dealer. I am a Series 39, 22, and 63 registered representative and a principal. We've been in business since 1994, and I've been representing and raising venture capital for REI Energy for the entire time that we've been in business. So I've specialized in oil and gas investments for the private investor.
Fantastic. Now, our conversation today is direct investments and direct investing into oil and gas specifically. Now, most listeners might only be familiar of a way to invest in oil and gas through ETFs on the stock market or buying a particular equity of a company that operates in this space. What are some of the other ways that they might not be aware of that you specialize in that people can participate directly as opposed indirectly through the equity markets?
Correct. We're a direct participation broker-dealer, and what we do is private placement offerings where the investors actually can invest in the actual working interest of the wells. They actually have ownership in the wells that they participate in, whether it be wells that are going to be drilled or wells that have already been drilled and are producing. So it gives them a direct ownership in the actual wells.
So they're investing as a partner in the wells, not buying an equity of a stock in the company. And there's different ways, of course, of how to participate in that, which we'll get to in a second. I think a great place to start for our overall discussion too is maybe if you touch a little bit on the oil and gas industry specifically. What's been going on there over the last, I would say, 10 years globally and specifically in the United States? What's currently going on, and where is the trends in this industry? What do you see in the future?
Well, over the last 10 years, we've had, of course, as everyone would know, the very high prices of oil and a large demand, and then a point where we, for the last 4.5 years, have been basically at very low prices. One of the things that happened during the last 10 years, of course, has been the advent of the non-conventional reservoirs production, such as in the Bakken in North Dakota, the Eagle Ford, the shale plays, basically, across the United States. And with the advent of the horizontal drilling and the advances that have been made in the fracturing process of multi-stage fracturing that they've been able to do on the wells, have increased the reserves in America and have increased the production in America dramatically. To the point that in 2014, right before we did have the crash in the prices, America, for the first time since 1994, is producing more oil than they're importing for the first time. And we have now, since the prices have come back, they have, of course, ramped the drilling and the production back up. And so we are getting very close to those same levels now that we are, producing more oil than we're importing on a daily basis. So that has been probably the biggest thing that's happened, because we're able to establish, reserves that, the industry knew was there in the shale plays, but basically did not have the technology to get them out commercially. And so that's been a big advance as far as America production. Globally, of course, you've had, great demand for oil. China being, one of the largest economies in the world, they have, advanced in these last 10 years from, being a not as big a player to actually being one of the largest importers of crude oil, in the world. And so the global demand has, of course, helped the prices. It's also, like I said, kind of, caused the prices to go down, but now we've got a demand that has starting back, and hopefully prices will continue to stay strong and to increase. Even though we've had a short fall back here the last couple weeks, still anticipate the demand for oil to be great, and that the prices will come back and stay in the in the $55 to $65, $70 range.
You've mentioned the supply and demand, which plays into the overall prices. What are some of the other factors that impact it? And specifically, we've seen quite a dip now in the past couple of weeks. What are some other factors that impact the prices of oil and gas?
Well, there's a lot of things that probably have to do with impacting the prices. Some of it has to do political things, like those kind of issues can cause that. But you have war, you have sanctions. A lot of those things can have to do with the prices being going down here in the last few weeks. One of the main things is that the sanctions on Iran oil, some of it was lifted for some countries to be able to keep accepting Iranian oil to actually help the prices stay lower, whereas normally that would cause the prices to go up. So you do have those kind of things that can happen as far as affecting the oil and gas prices. But in the end, I mean, the main issue with oil prices is always going to be demand. If you have a large demand or a greater demand, you're going to see the price of oil, stay higher.
Gotcha. Now, we had mentioned that this is a completely different way of investing directly into oil and gas, not buying ETFs or equities in a particular company that's operating the space, but you're directly investing in certain projects as a partner through a private placement memorandum in a project. What are some of the programs and different ways to participate in a play like this? I figured you could talk a little bit on the income side, on the speculative side. What are some of the things that folks can and how can they participate in this, and some of the programs available to them?
Sure. Well, you have drilling programs, and you have basically programs that generate income, which would be producing oil and gas properties. You have the ability to participate on both of those types of programs, and they can be merged. You could have a drilling program that has production in it. I mean, what an investor should look for in any type of oil and gas investment, of course, is diversification. And what I mean by that is having multiple wells in a program, because there are you can go out and be a part of a single well drilling program where you have one well that you're drilling and it's a hit or miss. That's the highest risk as far as investing goes, is in a single well program. So the wise investor and the smart investor is going to look for diversification where you have multiple wells, 4 or 5, up to 100 or more wells in it, depending on whether it's a drilling program or an income program. So that access to the diversification is probably one of the most important things to look at. And the other thing that as an investor would want to look at is what kind of percentage of the revenue that the partnership is receiving. In many cases, the revenue is not in favor of the investors. They're getting a small percentage of the actual production of the oil, or the revenue of the partnership. What they should look for is that where they're getting the majority of that production. So, for example, if you have a 100% production, the investors, should be getting, 75 to 90 to 95% of that, at least until payout. And then after payout, the numbers could change as far as that, where the promoting company or the oil and gas company is going to get a little bit higher percentage, but the investors should get the majority of the revenue in the beginning until they get a full payout of their original investment, because investors are putting up 99% of the money, and they should get the largest percentage of the deals and when they invest in it. And that's one of the things that that we look at, and when we put projects together, is that the investors are getting the lion's share of the revenue. So it's definitely a benefit for them to have a chance of getting their money back, and then also to see a profit on the programs. Another thing that they can look at is that coming in is whether they have the ability to come in on a drilling program or an income program is the times. Typically, your income programs where you're buying producing properties are going to be more beneficial when the prices are lower, because you have an opportunity to buy existing production at lower prices, and then you're banking on producing those wells, and that the price is going to go up, and so that you have a chance to double, maybe triple the investment if things work out as anticipated. And that is, of course, the income programs. If they're bought in the lower prices, do have the lowest risk as far as an oil and gas program goes, because you're buying a known producing entity, as opposed to going out and drilling wells where the potential for returns could be a lot higher. But there is more risk in there because you're actually, drilling the wells, and you don't know, no matter what someone tells you, or what someone would try to sell you on. The fact is that whether that well is going to be successful or not until you actually drill it. There's a number of things that you can do to, lower the risk on a drilling program. And one of those, for example, would be drilling in what we call proven reservoirs. A proven reservoir is basically a reservoir where you already have one well that has produced in that reservoir, and you're basically sticking another straw in the same container. That's your lowest risk. Proven reservoirs, the definition is where you expect to find oil and gas on a known producing structure. So it significantly reduces the risk, but there's still risk involved in when you go out and drill a well. So if you can be a part of a program that has a mixture of that, where you have drilling and income, that can be in a lot of cases your most desirable program as far as a brand new investor would look at being a part of.
So you can mix it up a little bit, just to summarize a little bit, between exploratory drilling and then an income well, where these wells have already produced oil and you're investing in a project into that's paying income. And then you've mentioned also that the investors recoup their capital first. The majority of the profits go to the investors. And then after that, they get paid or at a certain point in time, they get paid a monthly cash flow, and then they get paid, continue to get a cash flow. How long do these programs or these investments last? What's kind of the time frame? Because they're not very liquid in my, just from a little bit of research, or maybe they are. Please correct me if I'm wrong.
No, you're right on most of those things that you just said. It's not a liquid investment. It's not something you can buy and sell like a stock. So that's one of the factors you have to take into account as an investor when you come into it. It is a non-liquid investment. You are, into that investment until either, one of two things happens. Either the wells, produce for the lifetime of, and deplete, or if, the program, underperforms and does not produce as anticipated and eventually stops producing, oil. So you do have, those situations where you can, you're in a non-liquid investment. Now, the other alternative is, of course, is that when we put these programs together, what we look to do is to exit out of them on a good program, exit out of them in the, 5th to the 7th year. And what that means is that we will basically look at producing them for the first, 5 years, and then look at selling the project, provided the wells have produced as anticipated, and provided that all the drilling that we, planned on doing, to increase the revenue and increase the reserve base have been done. And then, the price of oil and gas has cooperated, meaning, it's more than what we, bought the wells for. So, you look at selling that now, and in that instance, all the investors would be able to get out at that point in time, because very few investors want to stay in a program for the life of it. And you don't want to stay in a program for the life of the wells, because there's plugging and abandonment that has to be done to the wells, when they're depleted. And so there's a lot of cost that has to be, done to these wells when they finally deplete. So you don't want to participate or be a part of that for that entire time. And we understand that, and that's why we have an exit strategy. Now, that exit strategy is always going to be in that 5 to 7 year period. But if things are better in, say, 3 years, then we could look at exiting them out in a sooner time. And then if they're not as good in that 5th to the 7th year, then we could stay in it and produce it longer until the prices did recover, and we could, basically then look at, the potential of selling the program at that point in time.
You're listening to Paul Mauceli on the Cashflow Ninja podcast. We'll be right back after word from our sponsors. Life settlement investments have allowed financial and banking institutions to not only buy their equity contractually, but also diversify their capital from any economic, market, and geopolitical risk. It's been part of the billion-dollar blueprint followed by institutional investors. And if you're an accredited investor, you can also now participate in this vehicle with enormous growth potential. You can watch an informational webinar presented by one of the premier organizations providing life settlement investments, Penumbra Solutions, at cashflowninja.com/life settlements. You're listening to Paul Mauceli on the Cashflow Ninja podcast, and now back to our interview. You've mentioned some of the risks, and obviously when you're looking to drill, you might not find oil, right? And some of the exploratory stuff, or and you've mentioned a couple of risk factors, obviously from an industry standpoint. What are some other risks that need to be mitigated and managed in this whole process and within your strategy?
Well, when you keep bringing up exploratory, you're right on that. Exploratory is the highest risk. Reserves are calculated three ways: basically proven, probable, and possible. Possible reserves are the exploratory reserves. That's where you're wildcatting or basically drilling, a well on a structure that has never produced oil and gas. And so the chances of finding that oil, you're basically swinging for a home run every time on a well, that you're going out and doing exploratory drilling. So, the national average, and this includes all, companies, large and small, is probably about 1 out of, 8 or 9 wells you're going to, hit, and you're going to miss the other, 8 or 9 wells. So we don't drill exploratory, and I would not advise anyone to participate on exploratory wells, because that's, you got a lot bigger chance of drilling a dry hole and losing, your entire investment, with those type of wells. And that goes back to the single well type of programs. What we drill is the proven reservoirs. The proven reservoirs are, again, already been established that the oil and gas is proven, and it's, producing there, and you're basically going in and getting, another container. You're putting another straw in that same container. So that's the kind of stuff that we drill. The other thing that, as far as risk, as far as going out and, like you said, drilling a dry hole is that, wells can underperform. That's another risk factor that you don't know until the actual well is drilled. How much oil and gas it's going to produce on a daily basis. Typically what companies do when they evaluate properties, you evaluate, what wells are capable of doing, is that you take information from other wells in that, in that area. So for example, in my proven reservoir, if that well that has already been drilled to the container you're drilling in is averaged 150 barrels of oil a day since it's started producing, then what you're going to, do is that you're going to base your well off of that type of production. And, because you have a reasonable, understanding that basically that's what that well's capable of doing. So you're going to base your economics off of that. Now, if you go out and drill that well and the well produces, 150 barrels of oil a day, and the price of oil that you have, projected for that, that period of time of its lifespan, then, that well has the capabilities of producing what you anticipate. But if you go out and you drill this well, instead of 150 barrels of oil a day, it only comes at 100 barrels of oil a day, then that well is going to produce less than what anticipated. Maybe not as, not where you won't get your money back, or where you're not going to have a chance to make a profit, but you're not going to make as much as you had originally, estimated with the your original production. So that's another risk factor in there. And you can have things happen with wells, that basically they can, mechanical issues. Those are things that could happen too. You could produce a well for 2 or 3 years, and it could have a mechanical issue that could cause it to stop producing, and the work that you do to repair it is not as successful as you anticipated. So it could come on and produce less than what, or in some cases, no production. You can have those issues like that, happen. So, those are risk factors that are part of, any oil and gas, program.
Let's touch on one very, very big a piece of this puzzle and this investment, and that's tax benefits. This investment is taxed a completely different way than many out there. Can you share a little bit more information on that? And I'll just obviously say the disclaimer, neither of us are CPAs or tax professionals. So please speak with your professional, but you're just some bullet points from a tax favorable treatment that this investment enjoys.
Sure, and that's one of the the big selling points of as far as an oil and gas investment, where you direct participation, because it does offer unique tax benefits that no other investment offers. And there's 3 tax benefits that you get with an oil and gas program. The first one is called intangible drilling cost. That is the largest, write-off that you can use. And intangible drilling cost is anything that's not reusable during the drilling process, such as labor, and a number of other things that are designated by the SEC. And so that you're able to write off 100% of the intangible drilling costs, in the year that the wells are drilled. And that typically represents up to about 60 to 70% of the investment. So, for example, on a $100,000 investment, you're able to write off $60,000 to $70,000 of that investment. Now, you get to choose how you write that off, as how you choose to come into our partnerships. You come in as a general partner or as a limited partner. You get the write-off the same way. But as a general partner, you can write it off against all income, active, passive, capital gains, ordinary income from your job, whatever income you derive, whatever your adjusted gross income is on your tax return, an IDC is going to reduce that. So, for example, if you have a $300,000 adjusted gross income, and let's just say you're in a 30% tax bracket, you multiply those two numbers, you're going to owe $90,000 in income tax. If you have a $70,000 IDC write-off, that's going to reduce that $300,000 to $230,000. Same 30% tax bracket, you now only owe $69,000 in income tax. So you had a 21% return of investment from the tax benefit alone in that example. And that's it's the only investment that I'm aware of that the government will actually help you in making the investment, because that's a real bona fide reduction in income tax that you would not have, been able to have without that IDC write-off. So that's a major write-off. And then, you do it by your tax, you do it by the size of your investment times the IDC times your tax rate. So if you're in a 35% or higher tax rate, then of course that return or that savings is going to increase. Then the other two tax benefits you have are the tangible drilling costs, which you typically look at as depreciation. You can depreciate that off your taxes. Currently in this year, with the new tax laws, we're able to, instead of write that off of a 5-year period, we're able to take it all off, in the year that the wells are drilled. So that typically represented about 5%, on an annual basis. So that would be added into the intangibles. So, this year we'd be able to write the intangibles and the tangibles off. And the tangibles are just the opposite, anything that is reusable during the drilling process. And then you have a depletion allowance, and the depletion allowance is for selling the product out of the ground, basically. And as an investor, you get 15% of the gross income and up to 20% of the net income that you receive. So once these wells go online and start producing revenue, for every $100 worth of net revenue that you receive, you don't pay taxes on $20 of it. The other $80 is what you're taxed on. So you receive tax-free income with, the depletion allowance tax benefit. And that continues, throughout the investment. So there's significant tax benefits. You get to use them either way, as a general partner or as a limited partner. The only difference with a limited partner is that you would basically only be able to write it off against passive income. So if you don't have any other investments that are generating passive income, then when these wells start producing, you would be able to write that income off with both your tax benefits, the depletion, and the intangibles and the tangibles. So the way it would work for a limited partner is basically you'd have tax-free income for the first 3 to 5 years of the program until you used up all the IDCs and for that and the depletion allowance. So you'd basically be getting tax-free income for that entire time.
What are some of the returns in some of this program? What can potential investors and what can they expect in participating in some of the programs?
Well, that's one thing I wanted to go back to. You said, you start getting income at some point in time. Once the wells go online and start generating, revenue, the investors start receiving revenue probably about, anywhere between 60 to 90 days after the wells go online. So they start getting monthly revenue at that point in time. And it continues each month, for the production that you would be receiving on that. The potential for returns, they vary from the type of programs. On an income program, you're buying producing wells. You don't have the risk of drilling, so you're not going to see the multiple potential returns that you would in a as opposed to a drilling program. You're looking at potentially what we would try to accomplish. What we'd like to do is to double the investor's return. And we'd like to, we looked at doing that in that first 5 to 7 years. Of course, that is dependent on the prices of oil and whether the wells have produced as anticipated. So that's what we would like, to do. The returns are always going to be based off of the life of the program. As one of your questions was earlier, these wells typically last anywhere from 15 to 25 years. So our returns will always be based off of over the life. But if you can sell it, in a 5 to 7 year period, the chances that you could, get a faster return on your investment is going to be much more advantageous to the investor as opposed to holding it for 15 to 20 years. On the drilling programs, depending on what kind of wells you're drilling, those returns can, be a lot higher. They can be in the, in the 5, 6 to 7 to 1 potential range. That if the wells produce as anticipated, and based on the price of the oil, that you would see, those kind of potential returns on wells that you're drilling in the conventional reservoirs, which is, the vertical wells as opposed to the unconventional wells in Louisiana. I mean, in North Dakota and South Texas and in the shale plays. Those wells are a lot more expensive to drill as opposed to the vertical wells in say Louisiana. A well in the horizontal plays, they're typically anywhere from $8 to $10 million to drill. Whereas a well in Louisiana, the vertical wells, you can drill some of those for $1 million to $2 million. So, those definitely lend to a higher potential return on the investments. And that's one of the things that we do is we try to mix that in. Like our current program right now has 2 wells in the North Dakota, and then we have 2 wells in Louisiana. It's a 4-well program with the potential of adding another, 4 to 6 wells, into that program. So we've kind of mixed that up to give you, the best kind of advantage from both sides. The high potential returns for the conventional wells, and then the steady production for the unconventional wells or the shale wells in the Bakken.
Gotcha. Now, Paul, a core message in our show is to leave our families and communities and the world better than we found it by passing down a mindset, values, and principles to future generations, not just money. So if you cannot pass on any money to future generations, and we're only allowed to pass on 3 principles to them to build wealth and achieve happiness and success, what would they be?
Well, the first one would be to make, investments and diversify in investments, not, just invest in one type of product. That's, invest in, real estate, invest in oil and gas, invest in, stocks, to, diversify your investments and not be concentrated in, one or more. That would be my, my first advice to, to people to look at investing. My second part would be, just to be, wise and to be, not go out and just, blow, all your, earnings that you're doing on, things to, foolish things like, things that you think that you need at that point in time in your life, and you really probably don't need it. more expensive cars, then that you probably shouldn't be buying, or a lot of expensive things that really aren't going to be beneficial to you in the long run. So that'd be my advice as far as for people going forward.
How can my listeners learn more about you, your company, and the programs that you offer for investments, and stay informed of all of the projects that you're involved with?
Well, it's our website is reienergy.com. We are located in Richardson, Texas, 1901 North Central Expressway. Our phone number is 800-422-1606. You're welcome to give us a call. Go to our website, to look at our offerings we have, and of course if you are interested, then we would of course put you as on our emails, so you would be getting any information that we send out regarding our programs in the future.
Fantastic. Well, thank you so much for coming on the show and sharing your journey and your knowledge and providing so much value for my listeners.
All right. Thank you for having me.
MC Laubscher here, the creator and host of the Cashflow Ninja and president of Producers Wealth, and I'm on a mission to help you achieve economic and financial freedom as quickly as possible. I achieve this by integrating the infinite banking concept with real estate investments to increase your efficiency and returns and recapture cash flow that you're not even aware of that you're losing. I share the #1 strategy for investors in my holistic wealth creation course at yourownbankingsystem.com. That's yourownbankingsystem.com. Thank you for joining me again on the Cashflow Ninja. Thank you for all your support. You rock. If you like what you hear and appreciate what we're trying to build here at the Cashflow Ninja, please subscribe, rate, and review our show on iTunes, and share our show with family, friends, and your network. If you're not a subscriber to our newsletter, you can sign up for our newsletter at cashflowninja.com or text Cashflow Ninja to 44222. I'm also posting daily videos on Facebook and YouTube, and will live stream weekly starting May 2018. To make sure you don't miss any of the live streams, please like and subscribe to my Facebook and YouTube platforms. I'm also dropping content on Instagram daily. Be sure to follow us on Instagram to get in on the action. I want to thank you for spending your most precious resource with me today, your time. That's our show for today. Until next time, live a life of passion and purpose on your terms. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.